what we're going to talk about today is how to construct a trade. And I'm going to go back through and apply the concepts that we learned in the previous videos that I put out there. The last video that I did is the universal kind of physics, the universal rules of trading, like the things that we have to do in every trade in order to properly construct a trade, create edge, do all the things that we need to do as traders. What I'm going to do and the mathematical sort of reasons behind it. What I'm going to do now is I'm going to review that real quick, but we're going to actually construct a trade from scratch and apply those concepts. And hopefully that'll make the connection between the theory and how to actually do this on a trade by trade basis. Okay, so first thing. The last video we talked about the universal elements of successful trading. Okay, so we talked a lot about the distribution, the importance of outliers. So we're gonna talk about that when we go to actually do the trade. But more importantly, the application of or creating edge, which is gonna be the first thing that we address. You know, what is the edge concept that we're using? In this case, for this trade, we're gonna use trend. I'm not gonna use mean reversion. Every trade at its core, when you boil it all down, is either going to be a mean reversion trade or a trend following or a momentum trade of some sort. Those two groupings, they're like genus, like animal and plant. There can be thousands of variations on those two concepts, but every trade is going to boil down to one of those two areas. You're either doing a mean reversion trade of some sort, could be a pair trade, could be a simple mean reversion trade and price action, or it's going to be a momentum trend following trade of one of 1,000 different variations. Okay, so we'll talk about that. For what we're going to do today, for the demonstration, we'll do a trend following trade. Now, that in itself is not enough. What you need to be able to do is to build a trade around it to account for the statistical or stochastic process that has to take place here. And that means we have to use a stop loss. The purpose of the stop loss, you can see here, is to get rid of the left side of the distribution. The price action, or the distribution of your trades, just to recap from the last video, is going to be in this like kurtotic distribution. And if you don't know what that means, or what it means is that these tails in the distribution, say it's a bell curve, the tails are what's called kurtotic, means they're bigger than expected. Those tails are where the outlier trades occur, the big winners and the big losers. Those are the trades we're trying to capture. Those are the ones that move the needle in trading. And we talked all about this in the last video. The purpose of the stop loss, say if I'm doing a long trade, is to allow myself to capture the large winning trade, but to avoid the large losing trade, which a certain percentage of the trades, 7 to 10% of the trades are going to be big losers, 7 to 10 will be big winners. If I'm going long, in this case, I'm trying to get rid of the big losers and capture the big winners. All right? If we're doing a short trade, it's vice versa, right? We're trying to capture something that drops a lot and make sure we don't get caught with something that goes up a lot. All right, so this is the model right here that we're trying to emulate, where we eliminate big losing trades and we're capturing large winning trades. The stop loss eliminates that side of it. The side we don't want, the side of distribution that we're trying to avoid. Targeting, well, same principle. We got to capture that big outlier over here. So targeting is really important. It's one of the issues that is very much underrated by traders. They just don't do it right. Especially people that know a little bit about trading. If they have a problem, it tends to be targeting. So in this case, what we're trying to do is, we know that about 7 to 10% of our trades, maybe even 5 to 7, depends on how you're looking at it, are going to be the really big winners. And those gains from those trades will account for probably 80 to 90% of the overall gains in our strategy. If you don't target correctly, you're not going to make money trading. You're just not. Your money's going to end up going sideways. We'll go through all that when we talk about diagnostics and how to identify problems in trading. But two of the biggest things are using a stop loss to make sure you get rid of potential for a big loser. We don't mind small losers. It's big losers that we got to worry about. Targeting correctly, that's the hidden problem that most traders who know something, who know what they're doing, that's the problem most of them have. We got to be able to capture large gains in order to make this work. And then the last part is sizing. Right? So sizing. You have to size your trades correctly in order to survive long enough to see this whole theory or the whole stochastic process, the distribution of gains and losses take place. You have to survive long enough for that to happen. And position sizing is a big part of doing that. I'll have a special video on position sizing that deserves its own attention. We'll go through that. So this is all stuff we already talked about in the last video. So we need to create edge. We need to have a stop loss. We need to size our trades, and we need to target correctly. So it's 4 things that we need to do. Okay, now, what does that look like when we're actually doing it? Okay, so what I'm going to do is I'm going to switch over to a trade here. And we're going to start with this trade in TradingView. Now, just to give you an example here, where I'm going to start the concept of the trade from is from edge. What am I trying to do here? What am I trying to capture? And what I end up doing is I look for a trend with good trend structure. And I'm looking for something that's moving in a direction. I'll go through all the specifics of this, but a tool, like I use this TC2000 to scan stocks. There's lots of other ways you can do this. I just like it. And one of the reasons I like it is I can look through it really quick. If I can get this to go here, just like this. So whatever time frame I'm looking for, and this is where you see the time frames for trend. And by the way, a very common question I get is, what time frames do you use? That depends on what kind of trade that you're setting up. The trade that we're going to set up today is an hourly trade. So what I had already done before I started this video is I went through a bunch of trades, or I went through a bunch of charts, and essentially just did this sort of thing where I'm going through looking for a certain set of circumstances, which I'll go through when I show you this. And what I came up with was Tesla. Okay, now I use the 65-minute trend, 65 minutes because it's a 6.5 hour day. So instead of using hourly, use 65 for equities. It fits in a little better. And when I did that, for a couple different reasons, I saw something that looked attractive for a possible short sale. So I'll go through that step by step. And this is a candidate. So a tool like TC2000 is really great in order to just quickly go through a whole bunch of securities. I use a lot of different filters. I've got a comparative relative strength screen that I use. It's very similar to the one that's used by IBD. I've got other tricks to help me find trends, and I'm able to go through these pretty quickly and find what I'm looking for. Okay, and any given time frame that I want. The particular trade we're going to do is a day trade. I could have done the same thing for longer term swing trades. Something like this. Or I could have went through in this time frame and found a trade that was interesting, like Copart, that maybe I wanted to use. Okay, so doing a day trade, and the security we found was Tesla. All right, so let me go ahead and now pop over to Tesla. So why did I pick Tesla? Okay, so the first thing that I'm looking for is edge. The first component in our 4-component breakdown I'm looking for is edge. In this case, it looks like Tesla just made a change in trend. Now, whether it'll persist or whatnot, I don't know, but it looks like it rolled over. Now, if you look here, I had actually, and this is in the 65-minute time frame. You'll see the time frame right there. I actually, in the bigger time frame, I actually think it was higher than 65 minutes. I had this area here marked for quite a while as a demand zone. There's one here, or supply zone, excuse me, overhead supply, where I think there's some sellers parked out. There's one there, there's one above it in the 330s. All right, now what happened was that marked here, that area held as supply back in August of last year, and here we come all the way back around again, and it came right back up into that area again and backed off. Okay. Now that alone wasn't enough, because this area had already been hit a couple times pretty deeply, so it wouldn't surprise me if it decided to go right through that area. What got my attention for a possible trade, and this is one of my favorite trades to do, is that we see the structure that developed here. Let me get rid of this. The structure I was looking at is this. 1, 2, 3. Now this is an impulse and corrective sequence, which you can see right here. Had an impulse up. Now when we talk about trend structure, this is what we're talking about. This is an impulsive move up with that gap on news. It pulls back in a corrective structure, okay? And then it rallies again in another impulsive structure, which takes it up into that area that I had talked about previously. Now, that's all pretty bullish up to that point. And even though it's in this overhead supply, that overhead supply had already been hit quite a bit. That's, it gives you an idea something might happen there, but, it could break through it if it's really bullish. If there's a catalyst that's strong enough to take it through. In this case, there wasn't. Right, and the key inflection point I was looking at is this break right here of the swing low. So here's the high, here's the swing low. Now, the break of that, and I'm just going to put that line right there, that blue line, tells us that something changed. So it broke this, what we call control swing low. And that puts this uptrend on the defensive now. It takes it off the... Like you want to go long this. It puts it on the defensive from being on the offense. Here, let me move this over. Up to this point, when it's at the peak, this stock's on the offensive. Now that it backed off of this, gapped down actually with a strong impulsive move, and broke that swing low, that now took it from offense to defense. It's the way to kind of think about it. Now, I definitely don't want to go long. The question is, do I want to go short? So let me get rid of this for a second. In order to go short, I need to see some structure going the other way. Like I need to see this thing establishing, downward structure to the downside for a potential trade. Now, first off, I like trades like this. I like when this happens because that quick switch from offense to defense gets a lot of long traders scared, right? Because they're losing their profits. They were just up X amount of dollars. All of a sudden, they're either losing money or they're seeing their profits erode quickly, and they're going to be much more defensive, trying to figure out how to get out of this trade. So that puts, that's going to bring more sellers in, bring in supply. Okay, so when I'm looking at this, I'm now going to look for some structure going to the downside. And in this case, what I see is starting at this lowest point, I see 1, 2, 3 right there. I see structure, and there's actually more than that. And you could even argue that the structure was, this went to a new low, something like, I'm going to pull that up here, something like that. Where you saw that kind of shape going on. It dropped, went sideways, and dropped again. I could have ran with that, but I'm going to go with this, where it's this kind of tight little 1, 2, 3 to the downside. That took it to a new low on this downtrend. Okay. That's one thing. Let me get rid of this for a second. Now, the next question I'm going to ask is, how far can this go? All right? Is there anything that's going to stop this thing? Now, in assessing that, because remember, I'm only trying to really go for the, I'm really going for the low-hanging fruit here. I'm just trying to get these moves that are kind of easy without a lot of resistance to pick up. And when I look at Tesla, let me pull this in a little bit. If I start from this swing low right here, this is swing low last May or last April. If I put a VWAP off of that, an anchored VWAP, and I anchored off that low, you can see here that most of the volume, like the anchored VWAP, is right up into this 228 area. That tells me where the average owner of the stock kind of owns it, is sort of the concept on a VWAP, right? Now, what's actually interesting about that area to me is you see this gap right here, this really strong move up. A gap fill takes it kind of back to this area of demand, and there's a lot of demand in here. There's demand there, there's right below it, all the way up as it went up, because it went up in that classic, impulse correction sequence. So there's a lot of, what we call demand zones, or stacked demand there. I'm going to choose this one, which is right about 233 it starts, because the VWAP agrees with it, right? The VWAP's right up in that area as well. So those two things together with the gap closure, closing the gap there, kind of suggests that it's going to pull Tesla down to that level, is what I'm thinking right now. Okay, so there's a good concept there. It's probably a lay down to get to that level. All right, so what's the rest of this mean? Well, if I'm looking for the structure to continue, all right, and here's the rest of the concept, then let me erase this for a sec. What I'm looking for is this. 1, 2, impulse, correction, impulse, followed by a correction, followed by an impulse. And the trick to doing a trade like this is trying to figure out where this turn is going to happen. Like where's that turn? Where's the corrective move going to end and the new impulsive move begin that should take us down to this level? And that's important because I gotta be able to structure the rest of the trade around that. I can get the entry, but I need to know where the stop loss, how to size it, and in this case, I got a good idea where my target's going to be. So this is the concept that I'm looking for. I'm trying to figure out where this turn's going to happen, and to do that, I'm probably going to need to go down another time frame and try to find an area. Okay, so what I'm going to do right now is I'm going to erase that. Replace it with this. And I know that I got to find that turn somewhere between the prior high, which is right there. Here, let me make that a different color. Make it red. Right there. Kind of move that up a little bit. And this point right here. So between that area right there is where I've got to find, on the last impulse wave is where I got to find the turn. I got to anticipate the turn somewhere in there. And that's a lot of room right there. Obviously, it's a lot of points. That's 20 points. So I got to zoom. I got to be able to narrow it down a little bit more. All right, let me take that. Oh, let me leave that there. Okay, next. I'm going to take it down a time frame. And maybe I'll go to something like 15 minutes. Okay, now in this case, usually what I'm looking for, probably about halfway up here, I'm usually looking for something, a shape that kind of looks like this, where it comes down, goes sideways, and comes down again. Something like that. A consolidation that I can use as an entry point. Tesla moved pretty quick. It eroded pretty fast in this little move down. So actually what happened here that's sort of interesting is we got a sharp move down, and then you see how it sort of just slowed down. It looks more like this. It wasn't able to go sideways like that. It kind of just dribbled off a little bit in this area right there. Let me narrow down the area that I'm talking about. Right there. Now that's what I would consider possibly what I'll call a running consolidation. Right? So there's three different types of consolidations. There's, let me grab this. There's a price consolidation, looks like that. There's a time consolidation that looks more like that. And a time consolidation would indicate a stronger trend. Maybe even stronger is when you get a running consolidation, which is down and kind of just slows down and then accelerates again, like that. And that's what I think we're dealing with right here. You notice the big bars leading into it and the big bars coming out of it, right? And there's the kind of consolidation slowdown. All right, now, one of the keys here in finding the right area also is that you need to have a breakout below the prior swing low. So let me just grab this line. I'm going to steal that line right there. And there's the prior swing right at that point. Swing down, right? Or we would call it like a reversal right there. And then there's the breakout right here that takes you below that point. Now, why is that important? Well, that tells you that the trend now is reestablished going this way. If that doesn't happen, if you don't clear that out, if you don't clear this out right here, then you don't know what it is. It could just be going sideways. It could be doing a lot of things. The fact that you broke below that point reestablishes the downward direction. Otherwise, you could be stuck in some sideways stuff that's not really going anywhere. All right, so that's important. Get rid of all this. Try to clean this up as we go. All right, so I'm going to look at this area right here. Now, I need a little more evidence about what I think is going to happen here. So what I'm going to do is I'm going to grab that VWAP again. I'm going to put it at this swing high point right here. And that's good because that's showing me that most of the volume in this last leg down, most of the shares have transacted, of the shares that have already transacted, are right about this 253 area, which puts it right into our zone right here. Now, I'm also going to look at something called a fixed range volume profile. And I like using these fixed range volume profiles. So I don't look at volume, bar by bar. I want to see where the volume actually traded price-wise. So by using a volume profile chart, you can look, say in a one-day period, you can see where most of the shares traded within a day. I like to use that same concept, but I want to use it within the context of a trend. And I want to see where the volume traded on the last impulsive leg down. Now in this case, you can see this smaller kind of pushback right here, impulse correction, impulse thing. Remember, we're in a lower time frame. Has created a point of control. That red line right there is what we call the point of control. Has put the point of control where most of the volume on this leg down is traded a little higher. That's about 258. So it would be better for me if they actually lined up a little better. If they both were at about 250-ish, that would give me a really good indication. So as it stands, I got two supporting pieces of evidence that are telling me two different things. One says, hey, maybe you should look up here. And that would be kind of in this area right there. Let me make that red. The other one's kind of suggesting, hey, this area that you originally thought right here might be a good spot. So I have two areas that I can build a trade off of. I'm going to take a chance here. I'm going to build the trade off the lower one. If that doesn't work, I can always, if I still think it's a good trade, I can always back it up and get the next one up. But I want to simplify this. Oh, by the way, if it breaks above this point, here, let me draw this. If it breaks above this 264.83, if it clears that area out, your whole concept for the trade is nullified. It's not what you thought it was. It got stronger than you thought it was. It's not going to work. Don't do the trade. Okay. Now I'm going to take that off. All right, so these are my three pieces of evidence. I got two zones. I got a supply zones. I've got a VWAP that says it should retest about 253. If you follow VWAPs, that's probably going to be a really good spot right there. And then the point of control is a little higher. I'm going with the VWAP for right now. Okay, now, if you remember, this was the other zone that we found in a higher time frame. We'll go back to 65 minutes real quick. That's that area right there. I'm going to use that as a target, right? So, let me zoom in a little bit. The concept for the trade here is that, edgewise, is that it's a downtrend. Here's the last leg in a downtrend. I'm anticipating that this will happen now. It'll do a corrective move back up into the zone and then come back down here. And I'm going to get out of this trade before it hits this. I'm going to get out of this trade right about there. So there's my entry on the short trade. There's my target. And I'm going to put a stop above it. Okay, so let me just erase this. There's our edge concept. Now, one of the things I'm gonna have to worry about here before I move further is whether or not this trade is worth doing. And what we have to worry about there is the risk reward profile good enough? Right? I don't want to do a trade. I don't want to risk $1 to make $1. Right? If I risk $1, I want to make, at least $5, $10. I prefer to do, bigger trades in the 10-to-1 area. So I'm just gonna grab a little tool here that TradingView has, and I'm gonna measure out here to see if this trade's even worth moving ahead with. Otherwise, I'd have to make some adjustments maybe. And this is a 6-to-1 trade. As constructed right now, this is a 6-to-1 trade. Let me get this off of there. All right, so I got a couple choices here. I can go a little deeper into the zone and make it a 10-to-1, or I can just roll with the 6-to-1. I think in this case, I'm gonna roll with the 6-to-1. And the reason is the VWAP's right there. So I'm gonna try to enter this trade like right at the VWAP. And that's my main piece of evidence in this downtrend right here. I'm gonna grab that VWAP. So I'm good. I'm good with the 6-to-1 trade. That should be okay. If I risk $1,000, I'm trying to make $6 grand. Essentially what it boils down to. All right, so let me go ahead and get rid of that for 1 second. Now, the way the rest of this is gonna shape up is that, put this right here. If I get in here at this VWAP, which is right at the zone, then what I'm gonna do is I'm gonna get out right above that area, that red area that you see, that's supply. Let me see if I can find it here. I'm gonna use that as a stop. Now this is where I want you to make the connection between theory and the practical application. That's where I put my stop loss, right? The idea being that of all the things that could happen with this trade, it could be a big winner, it could be a big loser, it could just be a middle of the road, do nothing kind of trade. That stop loss cuts off all these possibilities of big losers, right? The worst it can be for me is a small loss. And the loss is from 253.32 to 256.35. So $3. That's the worst thing that can happen to me here, is that I lose $3 on this trade. And I'm gonna risk $3 in order to make, what's that? Almost 20, right? So, where's my target's gonna be about 233, almost 234. Yeah, so it's like about $20. All right, so that's the concept on that one. Now, the targeting, again, the concept on the targeting and why I have my target down here, and let me go ahead and move that down. And this is where I'm gonna have the target. The reason why the target's right here is that a 6-to-1 target is going to get me in the area of, that's actually probably not a fat tail. It's a little higher up in the distribution, but it gets me in that range. It gets me in the minimum range that I'm really trying to get, 6-to-1. 5-to-1 is the minimum range that I'm trying to get. What I'm really going for, or really like to go for, prefer 10-to-1, 20-to-1, or bigger. And then see how it plays out. I can always adjust my stop losses later and capture gains, but that's the initial concept that I really want to get, is that if this thing drops off, I need it to pay. Okay, so there's two of the components. Now, I got stop loss, I got target, I got edge. The only thing that I'm missing here is size. Now, size is very important. One of the ways that you can blow up your accounts is by not using a stop loss. But the equivalent of not using a stop loss is by sizing your trades incorrectly. If you overbet your account, it's very easy to blow up your account. So what we're going to use is something called a fixed fractional position sizing. Fixed fractional position sizing. There's a lot of ways to position size. Kelly, half Kelly. There's a lot of more mathematically intensive ways to position size. What I would tell you is right now, what I would tell you is fixed fractional works the best for me. I think it's the easiest to do and the most practical, and it actually gets one of the best results. So the idea is that for each trade that we do, we're only going to risk a fixed fraction of our account size. And that doesn't include margin. So if I've got a $100,000 account, the size is determined as a percent of that account. So a 0.2, and that's 1/5 of 1%, risk per trade would be about $200 per trade. Now, my personal risk when I do a trade is about 0.2 to 0.25, somewhere in that range. So, no one trade really matters for all that much. The most that you can do and still not guarantee, at least not guarantee you're going to blow up your account, is 2%. That's the max. Again, I'll do another video on position sizing. I'll explain the mechanics of that, because when I show you, there's a physics to this. When I show you this, it has to do with the amplitude of the moves, and it gets a little involved. But if you go, let me just take it at my word for right now. If you go above 2% per trade, you're going to blow up your account. Your account's going to get smoked. It'll become unmanageable. 2% is still really big, right? Again, I'm much smaller. And we'll go into the specifics of that later. Okay, now, in this case, in this example, that $200 is the risk from the entry to the stop loss, not the total cost of the trade. That's a common mistake people make, right? It's how much you're risking on the trade. So in the trade example that we just showed here, that would be from this entry to this stop loss. So I'm going to use that. Example there. I'm going to use the $200 example. All right. So if I pull up a calculator here, let's see how many shares that we can do. All right, we'll pull that calculator down to this. All right. So the actual risk is from 253.32. So 253.32 minus, in this case, 255.88. 255.88. All right, so it's 256. 2.56. So from entry to stop out, if I did one share, I would lose $2.56. All right, so now I'm going to take the account size that we're going to risk. In the prior example, $200. So 200, let me clear it. 200 divided by 2.56 tells us that we can do 78 shares. All right, so if I do 78 shares, I'm going to lose $200. All right, just round it down, obviously. All right, so we know what we can do to risk $200. Let me just put it on there. $200 risk equals 78 shares. Okay. All right. So in this case, we're looking to risk $200, and the payoff is going to be 600, right? So 6 to 1. I think it was like 620. So it's $1,200 roughly. All right. So all you got to do now to do this trade, we figured out all four things. The stop loss, I can only lose $200 on the trade in this case, so no big losses. I figured out the target. Okay, so what makes sense here for a target is about $1,200 in profit, and technically that makes some sense there. Now, if it blows through that area, that target has another bullish setup at a lower price, I'll do that too. So, it doesn't. I have to get it all in this one trade. So I got stop, I got target, and I got size. I know how many shares I can buy or short in this case in order to only lose $200 at the stop loss, right? So I predetermined how much I'm willing to lose, and I backed into the shares. And I have edge, all right? And the edge component is that this thing is trending down in this time frame. It has broken control low structure, and it's establishing a new downtrend. And theoretically, the idea is that at this point, everybody just figured out there's something wrong, and maybe they need to get out, which should create some selling and hopefully get us down to this gap close. Okay, all we need to have happen now is have this thing come up, retest that VWAP, and we're in the trade. Okay, so now if I'm wrong, say la vie, I'm wrong. You know what I mean? I can maybe try it again at higher level if I really think it's still a good trade. But once it breaks this 264.86, let's just call it 265 level, the whole premise that I had was incorrect. And I should just back away from the whole thing. Okay, so with that said, I'll go ahead. I'm going to grab the short tool that TradingView uses. And hold on, do I have a trading panel here? I'm just going to paper trade out of this thing. By the way, this isn't the platform that I use. I use other platforms, TradeStation, the multi-charts, which IBD, that kind of stuff. All right, so I'm going to go ahead. I'm going to put right there. Now, with that red and green, the middle point between the red and green, that's the entry point. I'm going to pull the stop loss down. Now, there's ways of measuring how far the stop loss should be above it, volatility measurements, that kind of stuff. I don't usually do that. I'm usually just kind of roughing it. And let me see how much extra I gave it. I'm going to give it like 30 cents extra, maybe 40 cents extra. And then I'm going to pull the target all the way down here. Now, the little extra is going to take off my profit. So I'm actually going to give it a little less. Okay, I think that. So just all I'm looking for there is just that there's a confirmed break of that area that I was looking at. And could I catch a stop? Yeah. Could it screw me, like stop me out a little bit and then work out? Sure. You can't worry about stuff like that, guys. I mean, you just got to put the trades on. It's a well-structured trade. You know, anything can happen. So that's just the way it is. All right, and then there you go. Now all you got to do is, and our risk on this was, and this will allow you, by the way, this will allow you to pre-size to do everything we just did. If you use that tool, I just typed in that $200 risk that I wanted to risk, and it's actually adjusted my share amount to 68 shares. It's a little bigger when I added the extra. Okay, that's fine. I'll just go with it. I'm still risking $200. There's my entry right here at this proximal line. There's my stop loss, and you see the 199.97. All right, so that's 200. And there's my gains, which is in this case 13.35. So the gains are a little more than we thought, but the size a little less. Okay, and there we go. That's how you build a trade. That's the components put into practice. Is this the only way to do it? No, but the pieces all have to be there. You have to have an edge component. You have to have an edge concept, something that's going to make it more likely to go in your direction than not go in your direction. You got to have a well-structured process for figuring that out. And what you saw is when I did it, that's exactly what I did. Then once you figure out where you can get in, get out, where your target's going to be, we have to use a stop loss to make sure that we don't get any big losses. So, you know, if you think Tesla's going to zero, you think Tesla's going to the moon, whatever. It doesn't matter to me, right? I can easily just switch gears. If it's going down, I can make money on this. I know I'm not going to lose a lot of money. If it blows my trade out and it looks like it wants to go higher, I can just switch gears and go long. If there's another good setup. So you get married to the process. Don't get married to the trade, right, or to the stock. In this case, we have the stop loss in place, so that means any loss we have is very small. We have the target in place, and we know that there's an asymmetrical relationship. You notice there's a lot of green here. That's the reward versus a little bit of red, which is the risk. You have to size it correctly, or all of this didn't mean anything for your risk management, right? So size the trade correctly, stop loss, target, edge, and now you get all the components in practice and how to do a trade. And all you got to do is rinse and repeat this sort of thing. Again, just those elements have to be in place. You could replace any of these techniques you just saw me use with one of dozens of other techniques, but they have to fit together the same general way. That's just it. So this is what trading is. It's a process, and you just run it. Okay, hopefully that was helpful. We'll do more of this. I need to still make videos on the individual components, targeting, size, and then we're going to get into different tools, how to use them, things like VWAP and that fixed volume profile, and dozens of other stuff, as well as macro top-down stuff. So a lot of work to do. I'll try to just make these videos as I have opportunities and time to make them. But we'll just keep pumping them out. All right, thank you.